Let's just get some perspective on all of that. Evan Lucas is joining us from IG in Melbourne. Good Friday morning to you, Evan. Great to see you. Let's talk about this U.S. jobs data. I guess one of the most important takeaways from it is the inflation, showing that there aren't really any runaway inflationary pressures when it comes to wages, which of course means that the Fed can sort of relax in the sweet spot and put to rest some of those concerns that it's falling behind that inflation ball.
Yeah, that's certainly the case, and I think the other interesting sort of perspective out of the inflation part of it is again, there are questions about whether or not there is a sustaining sort of part of it, but that is the word that everybody's using overnight, and I think that's quite an interesting thing indeed, is the fact that they are now suggesting that the US economy has a self-sustaining drive behind it. So you've seen obviously leading indicators with regards to growth, that's now coming through in jobs growth, and that should lead through to consumer growth. Now that's why you can talk about that sweet spot, why they're not overly concerned they haven't reached their 2% target on the inflation yet, because they believe that is still coming. And now that we've seen unemployment at 6.1%, that's the lowest since 2006, so now completely overriding anything we saw from the GFC. We've also now got a situation where the jobs growth is now well and truly above the Fed's level. So all of that is very nice, and it's why Janet Yellen can continue to use her statements that they're going to have rates at a considerably low period, for a considerable long period of time at very low rates. So it is a sweet spot. That inflation is still a key, and you hit it on the head that the wage growth is the one part that maybe you can put a little bit of a concern behind. But now that we are actually seeing growth leading to jobs growth, leading to actual consumption growth, that may actually finally start to come to fruition as well. So that's why it's such a positive read, why people are so positive on it, and why the US dollar finally looks like it's actually starting to gain some strength and some momentum, because it may actually finally start to see the Fed talking about halfway through next year what they're going to do with the Fed funds rate particularly. Yeah,
and we have seen some of those investment houses massaging or toying with the idea of bringing forward their rate hike expectations from the US Fed. I mean, this is sort of adding to the desired effect that Glenn Stevens was trying to achieve with his jawboning down of the Australian dollar. But I mean, really, this US dollar story is not going to fully play out until we start to see those hikes, right? Because it's not a significant move up.
That's right, and I think that's the other thing you've got to be aware of here with regards to what is going on in the Aussie dollar particularly. And yesterday was quite an interesting day. It's the first time that we've seen, Glenn Stevens actually actively talk about the currency the way he did since sort of December last year. So the Fed, with the RBA meeting in February, he removed that complete talk about that uncomfortably high, and he did actually talk about that adjective quite directly, that this uncomfortable word being removed has actually seen the market do some fairly abnormal things. It's why he obviously believes that the market is underestimating when this devaluation will come across in the Aussie dollar. I think the biggest issue, again, gets back to the other side of the equation is the US dollar, and that's what most people are probably maybe overlooking, in the fact that the Fed funds rate is creating a carry trade into this country very, very easily. And it's not just out of the US, it's Japan as well. When you can borrow money for less than half of 1% in the US, and it can be as low as 0.2, and then come to Australia and come to AAA rated credit with regards to government debt, getting that at 3.7, even as much as 3.8%, that's a very, very simple trade for fund managers to make, and that's why you've seen that real ramp up and a very bullishness in the Aussie dollar US dollar pair from that February meeting, and that's the issue at the moment. That's what he's facing, is that he doesn't have the ammunition the Fed does, and that's why at the moment he's probably facing a losing battle. So it's very interesting to watch that today. 93.22 is the support level. We did see it try and get down there. It got to 93.4 in a bit. At that level, if it does fall through, then you may be able to make the conclusion that yesterday he finally sort of said to the market, I'm watching this and we're on a cut basis rather than on a hike basis. I still think that we're not going to move at all for the rest of the year. I think he's going to try and talk this up again, even though he doesn't want to jawbone it, but that's certainly the conclusions you can get out of what happened over the last 24 hours.
Interesting, though, that the US dollar didn't gain more significantly. However, let's just leave that aside. Talk about the materials space. So I mentioned in the introduction that it was one of the best performers. It was the best performing sector yesterday. Gold, obviously, we saw fall through the overnight period for obvious reasons. No real signs of inflation, etc. US dollar strength for the most part. But the industrials complex is going gangbusters. We've got copper up around 4-month highs. So do you think that we're really starting to see this traction being gained and this risk appetite for some of those materials plays here?
I think, look, from a leading indicator basis, you certainly can make that conclusion, and I'm actually on that idea. I think copper's been the most interesting one, and I know that we talk about it as Dr. Copper, and next week I think is key. Tuesday we see not only a plethora of China data, but absolute massive data drops in terms of where they're going, and we have started to see signs that China is improving. We've seen their manufacturing PMI, their services PMI, they're now back in expansionary territory. We've seen those, that major stimulus sort of targeted measures we've seen since around about sort of March, April, and that's now starting to play through. So Tuesday we see second quarter GDP. Expectations are for year on year at 7.4%. We see industrial production at 8.8 last month, so will be interesting to see if that's gone up. It's currently sitting at 2-decade lows, so that's one area very closely to watch. Trade balance is also due, always watching those exports, considering we've just been talking about the US and their movement in consumption. It's the same with Europe. All of that is what's going to drive it, and why the industrial metals are very, very interesting. It's why iron ore is starting to tick up. It made 96.50 overnight. That's another 1.9% increase. Now the September futures for that are currently sitting at 115.2 US a tonne. So there's still way to go. The Chinese are certainly still buying up September futures well and truly above the current spot price. So all of that suggests positive momentum, and as you alluded to at the start, it is interesting that the fact that you've seen some credit rating agencies starting to talk about BHP and Rio, they will obviously get away from that if we see an iron ore price on the way up. So all of that is good news. It's all good sort of data leading into reporting season, which I think is going to be disappointing considering what we've seen over the last quarter particularly. So there is good signs. We need to see that continuing into the back half of the year, but China next Tuesday is what to watch, and whether or not the first quarter of the second half of the year will actually be quite good indeed.
It's interesting because we did have that services sector read out of China as well, expanding at its fastest rate in 15 months in June. So is that side of the Chinese equation as important or gaining in significance to you now that we've got a little bit of the concerns about the manufacturing behind us?
Yeah,
because that's the great rebalancing, right?
What you said is correct. I think it's becoming important. When you become a consumption economy, when you become obviously a more advanced economy, services becomes the next part of your equation. And there's no doubt the Chinese are looking to that, and they have to service 1.3 billion people. So that is certainly the way up. You can see that in their tech space. You can see that in also their telecommunications. All of these services are now on the way up. It's probably not going to be as influential for the next 4 to 5 to 6, maybe even as much as a decade, but it will start to come, and there's no doubt the fact that the central government wants that to happen as well. So over time, it's getting more and more influential, and it's certainly a piece of data that you can watch very closely. And you saw yesterday the Aussie dollar actually started to come off when that sort of the non-manufacturing from the official side actually came at 55.0 compared to 55.5 last month. So that was seen as a slight negative, but the HSBC version of it was actually better than expected.
Yeah.
So there are certainly movements that are suggesting the market likes it.
Okay, just quickly, there's not a lot of data on the local calendar today. The Australian market has been outperforming, regional markets, at least the Nikkei yesterday. So where are you looking to for cues this afternoon?
Yeah, look, and the other thing you've got to remember is that it is July 4th, so it is Independence Day over in the US, and therefore you're probably going to see light trading, but there is certainly very good leads, and we look like, again, jumping above 5,500 points. I think we'll get to around about 55.18, 55.20, so that is a good increase, about 0.5 of 1%, which is nice to see. So I think we'll get light trading, but it will be positive trading. You've got, as we already talked about, industrial metals on the upside. I think you'll just see a little bit of support for the banks, and therefore that'll all be positive reads for the end of the week, what has been a very, very strong week indeed to start the second half of the financial year. Okay,
Evan Lucas, pleasure to see you. We'll chat later.
Thanks, Nadine.
Evan Lucas from IG in Melbourne.